So break-even analysis can be calculated with the help of these two approaches. The first is the equation method. The second is contribution margin method. So if we talk about the equation method, then profit is equal to sale minus variable cost plus the fixed expenses. So this is the equation that we have. So with the help of this equation, we can calculate easily what we want, right? So the second is sales is equal to variable expenses plus the fixed expenses plus profit. So in this way that we will be able to calculate the sales. So this is the equation method. So now look at this, how to calculate the break-even point. So at the break-even point, the profit is equal to zero. When the profit is equal to zero, so then we will be having only the fixed expenses. Plus sale minus the variable cost that we will calculate. So fixed cost, fixed expense divided by sale minus variable is equal to margin cost, which is known as CM, contribution margin. So here that we can see 250,000, right? So 150 that we have calculated that less variable expenses, contribution margin is this much, less expenses than 20,000. So 200 unit is the contribution margin here, and 100,000 is the contribution margin. So we can calculate. So break-even point that we have calculated, because the profit that we have, we consider this is a zero profit. So what is the break-even point in units that we are going to calculate, right? So break-even point units, that are the 400 bikes that we will be able to buy, and when there will be no profit and no loss. So this is the equation method. If on the other side, if we want to do with the other method, we can also calculate very easily. So this is already that we have done in the previous video. Now we can see the contribution margin method. So this contribution margin method is the fixed expenditure divided by unit contribution margin, right? So unit contribution margin means selling price per unit minus the variable cost per unit. That will be the unit contribution margin. So in this way that we will be able to calculate the break-even unit sold. So break-even point of total sales in dollars, that we can calculate the fixed expenses divided by CM ratio. So CM ratio is selling price minus variable cost divided by selling price. So this is the question in front of you. I'm just giving you some time to calculate this question. And so this is to calculate what is the break-even sales in units. So you can see that coffee clutch is an espresso stands in a downtown office building. The average selling price is 1.49 of a cup, and the average variable cost, variable expenses per cup is 0.36. Average fixed expenses per month is $1,300, and 2,100 cups are sold each month on an average. What is the break-even sales in units? So now you are going to calculate this break-even sales in unit. So what is that? Already I think that we have completed in the last video. So that was the 1150 cups that we sold, right? So how to calculate this one? The fixed expenses divided by contribution margin. So that will be 1150. So this is that we have already done. Now next question is saying that what is the break-even sales in dollar, right? So I can give you some time to calculate all the figures. So actually all the figures, all the numerical figures are exactly the same in the question. So I'm just going to give you some time, and after then you need to give me the right answer. Okay, so now the break-even sales in dollar. So what is that? The right answer here is 1715. So how to calculate the fixed expenditure CM ratio? So 1300 divided by CM ratio is a contribution margin ratio. So 1715, this is the break-even sales in dollar. Now, target profit analysis. So what is the target of profit analysis? For example, that the wind company want to know how many bikes must be sold to earn a profit of $100,000. So we can use CVP formula to determine the sales volume needed to achieve the target net profit figures. So CVP means the cost volume profit equation formula is that sale is equal to variable expenses plus fixed expenses plus a profit. So very simple, right? So in this way that we will be able to calculate what exactly we want. So here we know that the sales is like the 500 uh, and Q is the quantity. So $500 per unit and Q is the quantity here. We want to know the quantity. And 300Q and plus 300Q is the variable expenses, and here the fixed expenses and profit that we know. So this is the profit that we have written here. So in this way that we have calculated like 300, it has gone here, 500 minus 300, 200. So Q 200, that will be going that will be divided here. So $180,000 divided by 200, right? So this is 900 bikes. It means so 900 bike we need to sell if we want profit of $100,000. So this is the contribution margin approach. So we can determine the number of bikes that must be sold to earn the profit using this contribution margin approach, means the second formula. So in this fixed expenses plus the profit divided by unit contribution margin. So unit contribution margin, we know that. So it's a 500 minus 300. So this is the 200. So 180,000 divided by 200 is 900 bike. In the same way, exactly the same result that we can find with the help of this contribution margin approach. Now, this is the next question in front of you. So in this case, what is happening? Everything is same, but the thing is, how many cups of coffee would have to be sold to attain the target profit of $2,500 per month? So you need to calculate. Yeah, so that you need to calculate one thing, that is the target profit analysis. Okay, so I'm giving you time to complete this question. Okay, so what is the right answer? Like, so how many cups of coffee would have to be sold to have 2,500 the target profit? So this is known as target profit analysis. And look at this. So we need to have like 3,363 cups. So this is the right answer. The formula is in front of you. The fixed cost plus target profit divided by CM. So CM is the contribution margin, and the fixed cost is like 1,300 plus 2,500 is the target profit, which is already given in the question. So answer will be 3,363 units that should be produced to attain the required profit. Now, the effect of income tax. So to this point, like the tax has been ignored, because like we know the tax is very, very important, and this is the real expenses for the organization that they must consider in the decision making. To convert the after tax income into its before tax equivalent, we would use the following formula, right? So before tax income is equal to after tax income divided by 1 minus t. The margin of safety. So what is the margin of safety? So margin of safety is excess of budgeted sales over the break even volume of sale. So that is known as margin of safety. So it means the amount by which the sale can drop before losses begin to be occurred or incurred. So it means The margin of safety is whatever the sale is, sale minus a break even sale, right? So sale minus break even sale. If the sale is, for example, 100 units minus break even sale is 100 units, so margin of safety is 0, right? So we should know what is the margin of safety. So margin of safety can be calculated here in percentage. So margin of safety in dollars divided by total sale, right? So let's have a look. So in this case, wind company has a break-even point of $200,000, right? If the actual sales are 250,000, so it means if the actual sale is this much and the margin of safety is a 50,000, so margin of safety is 50,000 or 100 bikes. So what is the meaning of this here? Let's say in this case the unit is the 250, like 500 units, and this is the 400 units. So 100 unit of bike is like 500 minus 400, 100, so $200,000, right? This is the break even point. Why we say this is the break even point? Because we can see that after the contribution margin, right, the fixed expenses, there is no any profit. If there is no any profit, it means the 400 units is the break even sale. Now actual sale is $500. So 250 minus variable expenses, fixed cost, and 20,000 is the profit here. So look at this. Here, what I'm going to do, for example, the margin of safety can be expressed as 20% of sale. So 20% of sale, for example, here we can say the 50,000, this is the 50,000 in the sale, it has increased, divide by 250 sale. So margin of safety is 50,000, means the sale has increased to 50,000, right? Divide by 250 is the total sale. So it means the 20% of the sale. If we say that 20% of the sale, like this much, like 250,000, 20% of the sale is 50,000. So 20% of the sale is 50,000, right? So we have a profit is 20,000. Look at this. Now we need to calculate what is the margin of safety. So we need to calculate the margin of safety. So margin of safety, we know that what is the difference between the sales. So difference between the sale is the margin of safety, right? So this amount minus this amount divided by this amount. So this is known as margin of safety. So look at this. Now exactly the same information is available, but you need to calculate what is the margin of safety. Okay, you have the formula with you, so you can calculate easily. What is the margin of safety? I can show you one more time the formula here. Margin of safety is the total budget or actual sale minus break even sale. So break even sales is you know that uh, fixed cost divided by CM ratio. You already know that. So fixed cost divided by CM ratio. So that is the break even sales in dollars. Break even sales in dollars. Okay, so that will be margin of safety. So this is the question in front of you. So you need to calculate margin of safety. Okay, so now as per uh, the questions and answer is, so look at this. We have this answer. Margin of safety is equal total sale is 2100 minus 1150. So how the 1150 has come? So break even sale, which is like we know 1300. So 1300 is the fixed expenses. 1300 divided by 1.49 minus 0.36, right? So then we will be able to know that 1150 has come. So 950 cups. So that is the margin of safety. It's a margin of safety. So now if you want to calculate the margin of safety percentage, it's very easy. Whatever this margin mean profit. You can say the margin is a profit here, because like we want to know that even the break even sale is there. Till this particular point, we need to know that this much of sale is good and we will not be having any profit or loss. So that is the break even sales. So it means it will be covering the fixed cost, right? Okay, but we need profit. So total sale, if it is like 2100 copies of sale and this much is like this much of sale, so it means 950 cups is a margin of safety. It means from the 950 cups we will earn profit. So percentage will be 45%, like this. So next topic we have is operating leverage degree. So what is that? Leverage. So leverage that we are going to calculate here, the degree of operating leverage. So a measure of how sensitivity net income is to percentage change in the sale. For example, if there is a change in the percentage of sale, maybe up or down, then how that net income will be affected. This is the meaning of this. With high leverage, the small percentage increase in the sale can produce a much larger percentage in increase in the net income. What is the meaning of this? It means with high leverage, means leverage is this one, the degree of operating leverage. If the leverage is high, a small percentage increase in sale can produce a much larger percentage increase in the net income. Okay, now see, actual sales 500 bikes. So the sale is 250,000 and variable expenses is 150. 100,000 is the contribution margin, fixed expenses is 80,000 and net income is 20,000. Now next, so here we can say that operating leverage is $100,000, which is here the contribution margin divided by 20,000 is equal to 5. So the contribution margin divided by net income. All right, so this is one of the formulas, CM divided by net income. So 5 is the operating leverage. So 5 is the operating leverage. Now look at this. With a measure of operating leverage of 5, right? If wind company increases its sale by 10%, net income would increase by 50%. It means 10 multiplied by 5. So 10 multiplied by 5. This is the operating leverage, right? So look at this. So percentage increase in sale 10% and degree of operating leverage is 5 and percentage increase in profit is 50%. Okay, so this is 5 degree, 5 times. So how this is possible? And here is the proof. Look at this. So this is at the starting, if we say that some of the percentage has increased, let's say, so here like 250,000 and 275,000, some percentage has increased. So if some percentage has increased here, right, means the sale volume has increased, what will be the effect on the net income? So net income is like 30,000. So by increasing this much of percentage, right, let's say the 5%. So if the 5% has increased from here to here, like from 250 to 275, on the other side, net income has increased from here to 50%, has increased to 50%. Look at this. So 10%, for example, this is the 10%, right? So 10% increase in the sales, like 250,000 plus 25,000 is equal to 275,000. This is 10%. 10% increase in this is going to affect the 50% increase in the profit. So 10 multiplied by 5. So 5 is the degree. 5 is the operating leverage degree that we calculated. So 10 into 5 is equal to 50%. So 20,000, 50% of this is 10,000. 20,000 plus 10,000 is equal to 30,000. So in this way that we have calculated the operating leverage. Now we see, so look at this example. What is the right answer of this? So what is the operating leverage? Now you know all the formulas, right? So what is the operating leverage? You need to calculate. We know that CM divided by net income, right? CM divided by net income. Already that we calculated in the example. Okay, the right answer is 2.21. So how it is calculated? Contribution margin. So contribution margin divided by net income. So we know that 2100 cups, right? So 2100 cups, that is the annual sale, and the cup, the selling price minus variable expense is the contribution margin. So contribution margin in dollar, right? So divide by net income. Contribution margin divided by net income. So that will be 2.21. So that will be 2.21 is operating leverage. Now, next question. If the sale increased by 20%, by how much should net income will increase? Okay, so by calculating, we come to know the right answer is D. So how we have calculated? Look at this. So the degree, the percentage increase in sale is 20.00%, means 20%, multiplied by degree of operating leverage. So degree of operating leverage already that we calculated in the previous question. So multiplying this, the 44.20, that is the right answer. So percentage increase in profit. Okay, now next is sometime we have multiple product or multi-product break-even analysis. Many companies have multiple products, not only one product. Often these products are not equally profitable. The profit is different, the second profit is different, the third product is also their profit is different. So thus the overall profit depends upon the sales mix, right? So sale mix is what? Sale mix is the relative proportion in which the company's product or services are sold. So break-even analysis is more complex for multi-product companies, as each product will have a different selling price, will different cost price, and will different CM, that is the contribution margin. Okay, now if we talk about absorption cost and variable cost, absorption cost, that is also we calculated when there is a fixed cost per unit, right? And variable cost is a simple variable, all depends upon the volume of the sale. If it increase with the increase in the sale, and decrease with the decrease in the sale volume. Now absorption cost, all product cost, both fixed and variable, both that we calculate in the absorption cost. So we have already done that are assigned to the product, right? So both cost of goods manufactured and cost of goods sold will consist of both fixed and variable cost of manufacturing is the absorption cost. On the other side, we have variable costing. So variable costing is saying only the manufacturing costs that vary with output are treated as product cost, means manufacturing cost, direct material, direct labor, and variable manufacturing overheads. So both cost of goods manufactured and cost of goods sold will consist of only variable cost of the manufacturing. So only that is a variable costing. So fixed manufacturing costs are treated as the period cost and expensed during the accounting period. Now, same thing that are going to repeat it here. So computation of the product cost under absorption and variable cost. Absorption costing here and variable costing is here. So manufacturing cost elements. So direct material, direct labor, and variable manufacturing overhead, that we will calculate for the product cost in both cases. But we are not going to include here the fixed manufacturing overhead here, but we are including here in the absorption costing, which is also explained in the previous slide. Now we have here one more example. So this example shows that the difference between variable and absorption costing. We will look at this example. So look at this, the selling price which is given, that $100,000, direct material 19,000, then 5,000 direct labor, variable manufacturing overhead 1,000, fixed manufacturing overhead 70,000 per month, and variable selling and administrative expenses is 10,000, and fixed selling and administrative expenses is 20,000. So these are the figures we give. Now the price and cost data is here. Now we say that production and inventory data. So the flow of units in January, February, and March, 3 months are there. Opening stock was 0 in the January. Unit produced only 1. Let's say 1 dining table produced, and sold only 1. Ending inventory, that is 0. Next, opening balance 0 will come here, right? Opening balance February. 2 units were produced, 1 was sold, so 1 is the closing inventory. Closing inventory go to the March, that become the opening inventory. 4 units were produced, 4 and plus 1, that 5 units sold, and 0 was the inventory. This is the information which is given in front of us. Now on the basis of this information, we are going to calculate something. Now look at this. The first step is to calculate the unit product cost, and we will calculate the unit product cost under both variable and absorption costing. The first is the variable costing. So variable costing, we know that 19,000, 5,000, and 1,000, 25,000 is the unit cost. Okay, unit product cost. This is variable costing, unit product cost, right? So this we have calculated. On the other side, absorption costing, unit product cost, that we are going to calculate. Direct material, we know this is 19,000, 90,000, 90,000 for all the months. 5,000 that we know per month. 1,000 per month is the variable, right? So here the fixed manufacturing overhead, that we are going to add it here. So we know the fixed manufacturing overhead is the $70,000. That is the fixed, right? Fixed manufacturing overhead, maybe the rent of the building. If even the unit is produced one. So in the previous case, we know that in the month of January, the 1 unit was produced. In the month of February, 2 units were produced. In the month of March, 4 units were produced. 1, 2, and 4. Let's see. It's 1, 2, and 4. So when 1 unit was produced, the cost per unit that was 70,000. If 2 in February 35, and if 4, 70,000 divided by 4 units is a 17,500. Now, if the total comes to 95, 60,000 and 42,500 absorption cost unit per unit, and unit cost is going to change over a period of time, means every month.
Let's keep it on.
So absorption costing includes the FMOH, fixed manufacturing overhead, in the product cost. So this is the main difference between these. Variable costing, it is clear from the name itself, only variable costing. Here absorption means the variable plus fixed both. Now look at this unit product cost. So recap from the previous slide, absorption costing, that is the fixed manufacturing overhead is included the product cost, and a fixed manufacturing overhead cost per unit is equal to the total fixed manufacturing overhead divided by number of units produced. So for simplicity, we will use the actual production quantity as a denominator activity level. So therefore, assuming the company is using the actual costing system. So under the normal costing system means like we need to estimate for the future, like predetermined fixed overhead that will be used under the normal costing system. So denominator is used, that will be budgeted quantity, right? That we have completed in the budgeting part of the managerial accounting, and will typically result in the overall under applied overhead that we have already done. Now, so variable costing contribution format income statement. So using the information on the previous slide, the variable costing income statement can be created. So look at this, January, February, and March. So variable cost, the sale is the 100,000, 100,000, and $500,000. So this is the sale. So variable expenses, the variable expenses that we know that. So what are the variable expenses? So these are the variable expenses: 25,000, 25,000, 125,000, 10,000, 10,000, and 50,000, and the 35, 35, this much, and the total of all these things respectively that we can find it. So all these are the contribution margin we have calculated, right? It means sale minus variable, all variable. Here what we are doing, we are also subtracting the selling and administration expenses as well. Why? We are just calculating, we are making the income statement, we are just going to the accounting part, right? Format of the income statement. So in the income statement we need to calculate what is the actual net profit or loss. So this we have here 65,000, 65,000, and 325,000 contribution margin minus fixed expenses in both manufacturing as well as selling and administration expenses that we have calculated here, fixed. And this will be the 25,000 loss in the January and February as well, but the profit of $235,000 in the March. Now, so next is the absorption costing contribution format income statement. So in the absorption costing, what we are going to do? So 100,000, 100,000, 100,000, 500,000. So the cost of goods sold. So cost of goods sold is in this case like 95,000 into 1 unit, right? So we have calculated this much. 60,000 into 1 and 42,500 into 4. So what is that? So this is the cost of goods sold. So what is 42,500? That we have already calculated. I'm just going to show you. So this is the absorption cost unit product cost. So 1 unit cost is this much. So 1 unit cost is this much as per the absorption costing. So 1 unit cost we have calculated. So now as per the absorption costing income statement, One unit cost that we are going to multiply with the unit here, and that will be the cost of goods sold, right? So four units were there, so that will be the cost of goods sold here that we have calculated, because on that particular period that 4 units were sold. I can show you once again. So look at this, the 4 units were sold. Yeah, so this is the unit produced, and this was the unit sold is the 5, that opening balance was 0, and this is 0. So unit sold is 1 here and 1 here, this is the 5. Let me see once again, but this is the selling price, right? Sold, but unit produced, that is 4. So cost of goods sold, and this is cost of goods produced. Let me see what it is saying. Okay, so sale, this is the cost of goods sold. That will be, what is the cost of this? So 1, then 1 and a 4 here, that we have calculated the cost of goods sold. Margin will be this much, and selling and administrative expenses, that is 30,000, 30,000, and 70,000. Now we have a net operating loss is a 25,000, 10,000 profit, and 200,000 profit. So now we need to reconcile the variable costing income with the absorption costing income, right? So we need to reconcile variable costing income with absorption costing income. So look at this. So reconciliation. The variable and absorption costing net operating income can be reconciled by determining how much fixed manufacturing overhead was deferred in. So fixed manufacturing overhead was deferred or released from. So inventories during the particular period. Fixed manufacturing overhead deferred in or released from the inventories under absorption costing, right? So fixed manufacturing overhead at the beginning, in the January it was 0, and fixed manufacturing overhead in the end of the period was 0, right? So it means if it was 0 and it was 0 means 0 will be the fixed manufacturing overhead deferred. Deferred means that postponed or released from, right? Deferred. So in the February it was 0 to 35,000. That was the fixed manufactured overhead at the ending of the inventory, and the ending cost that will become the opening stock for the next one. Okay, now if we talk about reconciliation of the variable cost and absorption cost and net operating income. Variable cost net operating income or loss, that will be 25,000, 25,000, and 235,000, which is already given there, right? So now in this case, what I'm going to do, here the 35,000 is the plus positive, and here the 35,000 is the negative, right? So fixed cost overhead deferred. So same thing that we are going to calculate here, and that will be the absorption cost in net operating income or loss that we have here. So go back and we can see something like add or deduct the fixed manufacturing overhead deferred in the inventory under the absorption costing. So absorption costing per operating income, that will be here in a bracket is a negative figure. Now, if we see that comparative income effect, absorption and a variable cost. So what is the effect on the comparative income? So relation between the production and the sales for the period. If in case unit produced is equal to unit sold, whatever the unit were produced, exactly the same unit were sold, then no change in the inventory. If there is no change in the inventory, it means absorption costing net operating income will be is equal to the variable costing net operating income. So both these methods, that answer will remain the same. That will remain equal. The costing will be equal. But if in case the unit produced is more than the unit sold, so unit produced is more than the unit sold, definitely there will be a closing stock. So inventory will increase. If the inventory is increasing, it means absorption costing net operating income will be more than the variable costing net operating income. And if on the other side, unit produced are less than the unit sold, so production is less, but units sold are more, it means the stock has decreased. If the stock has decreased, it means absorption costing net operating income will be less than the variable costing net operating income. So net operating income is higher under absorption costing because the fixed manufacturing overhead is deferred in the inventory under absorption costing as inventory increase. And net operating income is lower under the absorption costing because the fixed manufacturing overhead is released from inventory under absorption costing as inventory decrease. Okay, so now what are the advantage of variable costing and contribution approach? The variable costing combined with the contribution approach and create many advantages for the internal report, means enabling the CVP analysis, explaining the changes in the net operating income and supporting decision making. So now at the end, we can say that we have learned the contribution margin income statement in the basis of a CVP analysis, and the statement separates the cost according to their behavior. CVP analysis provide the information on the sales margin and profitability. Manager can use this analysis to determine the break-even point revenue required to make the target profit, which is also known as analysis. So what kind of analysis? Target profit analysis. So and margin of safety, degree of operating leverage. So multi-product company can also complete this analysis, but take sales mix into account. Under absorption costing, the fixed and variable product costs are assigned to the product, whereas the variable costing only included the variable cost of the goods sold to determine the cost of the product. So this was all about the CVP, cost volume of profit analysis, that we have done.